Hi, it's Sean Havens with the Benefit Haven. I want to go through GUL versus IUL with you. This is kind of a series through the different types of life insurance that are out there. Some of the fundamental life insurance policies that you should be writing if you do life insurance. And GUL, not a lot of agents write it, and it's not very confusing. But if you don't know it, if you've never looked at it, then it can be a little daunting. So I want to make sure that you know about it and you understand how they work along with IULs, and really with IULs, so you're not messing up your clients down the road. So I'm going to go through this here with you. Before I do, make sure you're subscribing to our channel, guys, and giving us any likes if you enjoy our content. It's providing value for you, and it's helping you out there in the field in your appointments. And if you have any comments, leave them down below, and we'd be happy to answer them for you. All right, so GUL. What is GUL? GUL is Guaranteed Universal Life. Guaranteed Universal Life means it's not guaranteed that they're going to be approved. It means that it's guaranteed for their premium for a period of time. Their health is guaranteed, and for a certain death benefit. So let's say, for example, they get a $100,000 face amount. So that $100,000, let's say they're 50 years old, and we do a GUL to age 100. That means they have a certain premium. Let's say it's $100. They have a $100 premium that's guaranteed to age 100. Their $100,000 is guaranteed to age 100, and their health is guaranteed to age 100. All right, it's not really designed to build cash value because the whole idea is that they're getting a guaranteed amount of insurance for a period of time. We can go up to 121 with these. Okay, so when you're going and you're doing the actual quoting on this, you can kind of go through any of this to age 85, to age 90, to age 100, to age 121. And that means they're going to be locked in. They know exactly what their premium is going to be, and you can put it to whatever they're comfortable with. So if they're comfortable with 90 or 100 to age 100, then they can do that. So they know they're going to be insured to that time, as opposed to just doing a term policy where if they don't pass during that time, then they have no insurance or it skyrockets on them. Okay, so GULs are really good for for people that are looking for just to maximize insurance, and they don't care so much about the cash value. Quick note on cash value. So policies are designed to either get the face amount or the cash value. So they're not going to get both of them. So if they pass away, they're going to get the face amount. Where if they want to have access to cash value down the road, then if they take all of it out, they cancel the policy, then they have no face amount. So this is really designed for the death benefit, for having insurance for their beneficiary. Okay, so that's the purpose, or that's how the GUL works. And I will go through an actual quoting on this and walk you through this through iPipeline, which is a great tool if you're not using it. And if you join us if you contract with us, you'll have access to iPipeline. So it's a really good tool to use. It has all the carriers there. You basically just put in your client's information and it pops up the best companies on there, and with the best prices, whether it's tobacco, non-tobacco, preferred, standard plus, all the different categories. So it's really good if you do contract with us. Again, you'll have high contracts, so you'll be making more money on each sale that you make. Plus you have the back office, the life back office, to help you with case design and these tools as well. Okay, so with GUL, so the guaranteed, again, for a specific period of time, the death benefit's guaranteed and the premium's guaranteed to age whatever it is. Okay, so Guaranteed Universal Life. So that's how they work. I would highly suggest to add that into your bag when it comes to providing those to your clients. Because if you do, let's say you do an IUL or a whole life, it may be too much for them. But you can do a GUL because it's flexible. You don't have to have a just straight traditional whole life policy, okay? And you're not worried about the cash value paying for the premium like you do in an IUL or an Index Universal Life. So it's really in between that term. I would look at it as a permanent term policy, right? So it's not going to really build a whole lot of cash value, but it's a little more than the term because you're taking it longer. So they may pay more now, but it's going to guarantee that they're paying less later on. So when they're retired and their income goes down, then you're not going to be you're not going to be having they're not going to have these high premiums, right? So that's really what the GUL is designed to do, is to keep that in force long term. Okay, so these are great policies. You can also do these policies for a single premium or 10 or 20 pays. So those are great too, because you can really set somebody up for their retirement by making sure that they're not going to have those premiums in retirement. So those are great as well. Okay, so Guaranteed Universal Life, highly suggest to get into that, learn more about it. I'll do additional videos on it as well. Okay, so I want to move on to IUL, which is Index Universal Life. So I'm not going to go in exhaustive training on this, but I will go through this a little bit because I think this is so important. I can't tell you how many policies I've run into that maybe young agents in the business, when I say young, just inexperienced agents, have written these policies, and maybe they did a minimum premium or just over the minimum, and now these clients that I run into, they're going to retire, and they've just gotten a letter saying you need to pay more premium to keep this in force because there's no cash value left. Right? Or they need to drop their death benefit in half. The problem is that's going to keep happening, and I'll tell you why. So the purpose for IULs, let me go into that first. So the purpose, these are good for people in their 20s, 30s, even 40s, where they have time to allow the cash value to build up. So really what you can do is, these are good cash value building policies where you can overfund it. So these are flexible. So let's say for example you have a target premium of $50. They can put in $200 a month and really overfund that. Because what happens in these policies is this: with an IUL, you have a cost of insurance. Okay, so let's say that's a $100,000 death benefit. There's a cost of that insurance that they're paying. Anything over and above that cost of insurance is going into cash value buildup, which is now into, let's say, the S&P 500, which is pretty standard, 500, Standard & Poor 500. So that's going to be the most popular indice. So let's just take that one for example. So let's say their cost of insurance is $50 and they're putting in $200. So now they're putting $150 into the S&P 500. Okay, so what they're doing is, now let's say that S&P 500 they're going to have a cap rate of maybe 10%, just to have round numbers. So that $150 in that year, let's say they have a point-to-point strategy where they're making, every year they allocate whatever cash value buildup they have into their policy. So let's say they get maybe 10%. They max out. The S&P has a good year. They do 15%. They're 100% participating up to 10%. So now they take 10% times all the difference in the premium. Let's say it's $150. So they're getting 10% of $150 a month, or $1,800 a year, into their cash value. And now that's growing tax deferred because they're not paying taxes on that every year. They only pay taxes if they were to take it out. Right, so that's how those work. Now down the road, let's say there's $50,000 in cash value buildup in your IUL, or in your client's IUL. So what's happening is you're paying the same premium, so $200. Well, eventually the cost of insurance for that $100,000 is going to supersede that $100 or that $200 that they're paying. So in this case, they are now using their cash value buildup to fund the difference in that premium. Let's say the cost of insurance is $300 at some point. Maybe they're 70 years old and it's $300. Well, if that's the case, then they need to take $100 a month from their cash value and apply it to their premium so that their premium doesn't go up. So that's what's happening. That's how the policy works with the IUL. So that's why you really need to overfund that thing, or you at least need to fund it enough to where down the road they're not stuck in a situation where there's no cash value and they're having to pay all this extra premium, right? They're having to pay the entire cost of insurance. That's just bad planning on the agent part, okay? So, or the agent side, and that's not what we want to do to our clients, because they think they have life insurance for life, and what ends up happening is they end up not having it when they need it. Okay, so make sure that you learn more about how to design it, that cash value is going to be there for them. Okay, and that you're not doing it for maybe somebody in their late 50s where they don't have time to build that cash value. Okay, so that's not really the time to do the IUL products, right? So anyway, that's kind of how the IUL works. The purpose for it is really to build that cash value, to have a permanent policy if you structure it right, and knowing that they have to have overfund that a little bit and have that coincide with whatever indice that they're allocating that money to, so that they can really build that cash value over time. And you can also use it for income. So they can have it coming in for income down the road as well, where they're overfunding that and then they're using it as an income, which is a whole nother video that we can get into, and we'll do that as well. So that's really the difference. The GUL is really designed to have insurance, to have maximize the insurance to a certain age, and the IUL is a little bit of both, where they're going to have the insurance, but they can really have that cash value build up as well down the road. So that's how those work. Again, I will go through an illustration. I'll go through how to quote that. A lot of the companies now have the software directly on their website, where before we were able to download the software to the desktop. A lot of them are doing the online quoting now. So I'll go through the quoting, the illustration, how it works, and making sure that you're doing the right thing for your clients on the IUL. So I'll do that in our membership group. And the benefithaven.com, the Mentor Haven is where you can find that. And we'll go through more in-depth dives of how these things work. I'll lay it out for you. And I'd love to see you there, be a part of a community of insurance agents across the country. So I'm going to go into our next video about more types of life insurance and different products that we do offer as well. So I hope you enjoy it. Make sure you subscribe down below. Hit the like button if you're enjoying the content, and we'll see you in the next video.